can be classified into two major categories. One is internal source of finance and other is external source of finance. Now, whether a business should decide internal source of finance or external source of finance, there are some three factors which a businessman need to keep in his mind while selecting about internal or external source. Those three factors are obligation, responsibility and opportunity. An entrepreneur has to see, because every source differs. Internal and external sources differ on the basis of obligation, that what we have to pay in return of it, how much responsibility comes with that source, and how much opportunity is there to grow with that source. And then we have internal funds. Internal funds are those funds which are generated from within the organization. That money which I have generated from within the organization, that is internal fund. Now let's understand what are the various sources from which I can generate internal funds. First source is past savings. We can use our past savings for expansion purposes or for business purposes, for investment in the business purposes. Then another source is retained earnings. Let's say if you are doing business from last number of years, then what you can do, you can use your past business savings for investment for growth purposes, growth and expansion purposes. What is the meaning of retained earnings? Let's understand. Retained means residual or remaining. Profit means that profit which is residual in your business, because generally what we do, whatever profit a businessman earns after deduction of all the expenses and taxes, then that profit divides into two parts. One part is in the form of dividend, which is given to shareholder. Another part of profit is kept for future use. That part of profit which is kept for future use is called retained earnings. So now we can use those retained earnings for expansion and growth purposes. Another is sale of asset. We can also generate money by selling some of the assets, definitely those assets which we are not using. Another source of internal fund is squeezing working capital. When I say working capital, it means the capital which we are using for day-to-day expenditure. We can arrange more funds by reducing our day-to-day business expenditure. That is squeezing day-to-day expenditure or squeezing working capital. Chasing up debtors or delaying payment. Another way is that we can chase our debtors are the ones to whom we have sold the goods on credit. We can request our debtors to pay money in time to us. We can use that money as an internal fund. Other than that, if our debtors don't pay, then you don't pay to your creditors. Creditors are the ones from whom we have purchased goods on credit. So if your debtors don't pay, then you also don't pay money of your creditors. Till the time your creditors don't take money from you, you can use that money in your business. Then we have sale of little used assets. Those assets which we have got, but they are like they have this kind of, we can say, blocked our investment. They are a kind of block investment. So instead of keeping them idle like this, better you sell them in the market and generate the money. Another is procuring asset to rental. This is also a very easy way to arrange the capital. Let's say if you go to the market and buy the machine, then you have to spend 50 lakh rupees to buy that machine. Instead of buying it, why don't you take it on rent? If you will take it on rent, or you can take it on lease, then let's say if you can take it on lease by paying lesser amount of money, that will save your money. So instead of buying the assets, you can take it on rent or lease. And the benefit is once that when that asset will need updation, then in lease and rent it's easy to get the updated asset also. Another way is sale of redundant assets. Those assets which are obsolete now, they are not in use, better sell them off and arrange money. Reducing short-term assets. As we said, reduce your working capital. Keep your less in cash, less inventory. Don't keep huge amount of stock. Don't keep piles of stock. Better keep limited amount of stock. Then whatever money you have saved by not keeping excess stock, by not keeping surplus stock, excess of surplus stock, you can use that money for expansion or growth of your business. You can use your money as an internal fund. So these are the sources from which internal funds can be generated. Then there are external sources of finance. When a business, it is not possible for a business, or it is not sufficient for a business to arrange money from internal funds, then those businesses can take the help of external sources of finance. As its name is suggesting you, external sources of finance means arrangement of capital from external sources, from those sources which are outside the business. Let's understand what are the various sources of external sources of finance. The first is debentures and bonds. What are debentures? Debentures are issued by company to general public on its authorized document, and it's a kind of loan. Debentures is a kind of loan which is taken by company from public, and in the return of this loan, company has to pay the interest to debenture holders. And keep one thing in your mind, these debentures are very risky. Debentures are very risky. Why they are risky? Because this interest payment and repayment of debentures. If you have issued 5-year debentures, then after 5 years you have to repay this money of debenture holders. Otherwise, your goodwill will spoil in the market. If your goodwill will spoil, then next time no one will give you credit, no one will buy your debentures. So the debentures are very risky, but lesser costly than issue of equity. Then loan from financial institutions. Other ways that you can take, if you need long-term loan, more than 5-year loan, then you can get that loan from financial institutions also. There are specialized institutions which are there to give loan to industries or businesses. Loan from commercial banks. If you need short-term loan, then commercial banks are there, like all the consumer banks, whatever are around us, ICICI, all these commercial banks are there. We can, if we need short-term loan, less than 5-year loan, then we can get it from commercial bank also. Public deposits. Let's understand the term public deposits. Public deposits are taken by the company from public. In this, company asks the public that you come and keep your deposits with us. Instead of keeping it with bank, you come and keep your deposits with us. Now public says, why? Why should I keep my deposits with you? If I'm keeping it with bank gives me interest. What will you give me? Then company says, see, if you keep your deposits with the bank, then bank gives you interest of 5. Let's say bank give you interest of 2%. Then in that case, I will give you interest of 5%. I'm just quoting an example here. I will give you interest of 5%. So if you will keep with bank, you get an interest of 2%. But if you keep your deposits with me, company says to public, if you keep your deposits with me, I will give you 5% of interest. Better you come and keep your money with me. Then company says, instead of asking us to keep our deposits with you, why don't you go and take loan from bank? Then company says, if I go and take loan from bank, then bank charges interest of 10%. Bank charges 10% interest on loans. Bank charges 10% interest on loans. See, what is good for me? Here, I'll be getting this money from you at 5%. If I take this money from bank, then I have to pay 10%. So it is good for me to take take deposit from you. This way you are also in benefit. I am also in benefit. So the deposits which company take from the public is called public deposits. And this money can be kept by company maximum for a period of 3 years. Trade credit. When the credit is taken while buying the goods. Let's say I have to buy raw material. I'm a business. I have to buy raw material of let's say 40 lakh rupees. One way is that I get 40 lakh from the market. I take a loan of 40 lakh from the market, and then give this loan, whatever money I have arranged from the loan, give this to my seller who is selling me the raw material. Another way is that I can ask my seller only that, okay, what if I give you payment after 3 months? What if I give you payment after 2 months? This kind of credit is called trade credit. Then intercorporate deposits. Intercorporate deposits means businesses can keep their deposits with each other. So thank you very much for watching this video. For more details and next lecture, kindly stay tuned, and you can visit our website studyresearch.in.